Before we get into the episode, a quick reminder that this podcast is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. If you are enjoying Onramp media content, please like, subscribe, and share, as it goes a long way in helping others find the signal through the noise. Now for a word from Onramp. Onramp is a Bitcoin asset management platform built on multi-institution custody, leveraging our partnership with BitGo and their 10-plus year track record in securing assets, and CoinCover, the premier digital asset risk mitigation company. Onramp's multi-institution custody is a segregated, institutional-grade vault, requiring 2 of 3 institutions at any point in time to sign once a client's unique permissions have been met. At Onramp, we understand that your Bitcoin journey is a multi-generational pursuit, catalyzed by the ideals of perseverance, aspiration, and legacy. That's why we're proud to introduce Onramp Heritage, a suite of private client services dedicated to ensuring your Bitcoin legacy is preserved and passed on, embodying the true essence of wealth that goes beyond mere numbers. If you would like to learn more, please schedule a consultation. As we prepare for the Bitcoin halving and the next wave of global adoption of this nascent and growing asset class, we are halving all annual maintenance fees for clients that secure their wealth before the next Bitcoin epoch.
What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974. 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
We've got a very unique setup for this show. Jesse and I are in Texas, and Michael is over in London, joined by the Cartwright team. Glenn Cameron, who's been on the show before, and Sam Roberts, the CIO of Cartwright. Michael, I'll let you open this since you, Glenn, and Sam have been hanging out and talking for the last couple of days. What's going on over in London?
Well, we took a red eye from Texas last night, hopped over the pond and went to meet Glenn and Sam and had some good conversations. Excited to roll into this. This is one of the ones that I think I need to say less of, and we have experts in the room, asset allocators that have been looking at Bitcoin for a very long time, and excited to have a conversation with them.
I'm as well. And Sam, before you re-entered the room, I couldn't see you before, but I thought I was telling you, I was just telling Glenn and Michael that the first time Glenn was on, he explained how he joined Cartwright and the interview process he went through, which was essentially you making sure that Glenn understood Bitcoin and Bitcoin specifically. And I think for the purposes of this show and just building on the first episode we did with Glenn, it'd be really interesting to learn about your background, how you became so convicted on Bitcoin particularly.
Yeah, sure. So brilliant to be here, by the way, and good to be live with you guys. It's obviously seen you in the past on previous podcasts. And yeah, that trick question I asked Glenn was, what do you think of crypto? And I'm pleased to say you passed. Otherwise, you wouldn't be here. So my background is, I'll take a step back and then sort of take a run up into how I've ended up here. So I'm an actuary by career choice. That's since started in 98, so many years ago there. And I first started sort of having thoughts about things aren't quite right in 2008. And that, I was looking all over the place for answers to that. Found myself going deep into the Austrian School of Economics. I think it's a natural step from there, certainly in those days, to then end up as some kind of gold bug. So I think that's a commonly treaded path. I was then focusing on my career for the next few years, and then came back to, I heard about Bitcoin in 2013. I did what I normally do, which is I dabbled. Obviously, in hindsight, I wish I'd dabbled a lot more than I did, but sort of just tested it out a little bit, and then forgot about it. I didn't really understand it in reality in those days. But then it rolls around to 2020, and obviously everything that was going on then, central banks taking action as they want to do, and into 2021, where I was then had the chance to go a bit deeper into Bitcoin again. And I took the path again, pretty well trodden, I think. I had a slight diversion into crypto, which I dabbled again. So again, as an idea, does it make any sense? I feel I have to test it out for myself, which is what I then did. I then very quickly realised that it was a dead end, essentially, to put it politely, which then helped me to come full circle back again to say, okay, so it's Bitcoin only. So that takes us to sort of late 2021. And then 2022, a key date in my mind was, I think it was 24th of February 2022. So that was when, that might have been when, I can't remember the exact date actually, saying that, but it was Russia had invaded Ukraine at that point, and it wasn't so much that, it was more the event of the US and indeed other nation states confiscating Russia's treasury bonds. And for me, that was a real inflection point. So I'd built up a Bitcoin-only understanding at that point, and understood about the lack of counterparty risk if you hold it in the right way, etc. And for me, it wasn't about whether Russia was right or wrong or whatever thing. It was the fact that one nation state had confiscated another nation state's assets, just a stroke of a pen. And that for me was a turning point. So it was a couple of days later, I had a team meeting, and I said, okay, I think they were all a little bit shocked, but I said, okay, we now need to be thinking more carefully about Bitcoin as a serious option for our clients. My expectation, which I think I told you, Glenn, actually, at that time, was that it's going to take a couple of years for us to get to the stage where clients are going to be able to invest, possibly a bit longer. So 2 years rolls on, we're almost at that 2 year point, and we're very close, I think, to helping clients get into this asset class. So it's a very exciting time. It's been a long time coming, but I'm very pleased that we're here today.
Yeah, it's crazy to think about somebody in your shoes too, as the CIO of Cartwright, and you have this duty to your end clients who may not be doing as deep of research into these subjects as you have, to make sure that you're getting them the right information. So leaning into your personal journey and having to basically come to grips with the fact that crypto is noise and Bitcoin is signal. As you mentioned, the confiscation of treasury assets is a very large event that really highlights this counterparty risk exists throughout the system, and Bitcoin is the solution. And then having the wherewithal and the foresight to say, okay, we've got to go on this journey to develop a thesis and a process internally before we can go get our clients into this years down the line. How do you sort of pitch this to your clients now that you've spent this amount of time, 2 years, building out a process, building out a thesis, finding the right counterparties to get you access and your clients access to Bitcoin? Have you been pitching Bitcoin along the way, or is this a point now in time, February 2024, where it's like, all right, we have everything in order on our end, we can then go begin telling our clients about this?
So we started seriously telling clients in October, just gone. And that was in the context of an asset allocator, portfolio construction. These are people, our clients are people that look after other people's money. And I think that's a really key difference. Me personally, or anyone else personally, you can dabble, right? You win some, you lose some maybe, but you can dabble and you can test things out to understand them better. That's fine. But that's not what our clients can do in the same way. They need to be much more confident in what they're investing, and much more confident they can get the advice and the proper analysis around that. So we very much pitched this as a small allocation to Bitcoin. And Bitcoin only, obviously. But the small allocation is also important. And because it helps them to dip their toe in the water. I think also what helps the small allocation from our point of view, and this may be something we can dig into a bit deeper possibly, but in simplistic terms, I think we've got a couple of phases coming up. So we've got the monetization phase, and then we've got the increasing in value in line with economic growth generally. So sort of what gold has effectively done for a few thousand years, the old Roman suit idea. So you've got two distinct phases. And the advantage of that first stage is that you can justify putting a small amount in, 2, 3, 4% of a portfolio, and you know what your downside is, 2, 3, 4%. But you've got this massive upside potential. And I think that is what is extremely helpful at this stage, because when you start plugging it into any kind of investment risk model, it looks very attractive.
Yeah. To take a step back, I think it's always fascinating when Glenn first came on, and Chris Kuiper and very senior professionals that are used to speaking the language of asset allocators. You guys have amazing positioning. There's a term inversion that Chris brings up. I was just talking the other day. It's not going to come off the top of my head, but there's this angle of being able to like flip, like what would cause Bitcoin not to work, or what would cause it to not appreciate. But to go backwards, we kind of glossed over the question to Glenn about, I think it was very transformative or very important to the whole process of you guys like finding a person to lead this unit. And I say that because as we're coming out east, we're going to be in the UAE. There's folks that we're talking to in India, in Dubai, Abu Dhabi, the Middle East, and this idea of counterparty risk is understood by them. And they understand that the ETF may not be the solution, similar to what you're saying about the treasuries. Different angle, but similar concept of like, who's your counterparty? And when we met Glenn, it was top of mind all the way up the stack. What do you invest, or what do you offer? What's the counterparty, the solution from a custody perspective? Do you, the delivery mechanisms, all these things that were important. And so going back to that clever question, there was a test there, but I'm curious, like, how did you think about why it mattered and how you had to find the right person for this whole like journey? Because I think that's like one of the most pivotal points, to find the right person and the right counterparty to make sure that you could actually get the right like solution. And
we're fortunate this is a growing area, and therefore these opportunities are more likely to come along than if it's a contracting area. And so Glenn's been fantastic. It was a bit of a coincidence in terms of the timing. So I mentioned February 2022. Glenn joined in May 2022. Obviously, we'd had some discussions before February. So that worked. That worked very well in terms of the timing. And I think our clients are looking at it partly from a counterparty risk point of view and partly from an inflation point of view. I mean, they're not mutually exclusive scenarios, economic scenarios, but in some ways it's simplified down to that. So you have a economic contraction that increases your counterparty risk. It increases your counterparty risk. If you own bonds, are they going to be able to pay you the coupons? If you own equities, what their profit's going to be like? If you own property, are they going to pay the rent? So there tends to be a correlation with higher counterparty risk in an economic contraction. And then, of course, the flip side is that the central banks printing, creating inflation, the hard cap of 21 million then really comes into its own. So you've got this fantastic combination of extreme scenarios where historically gold would have played that role. But of course, now we're in a new world, and Bitcoin is, I think, gradually going to take over from gold in that role. Does that answer your question?
Yeah, I think so.
Yeah, you raise a really good distinction there that I don't think we talk enough about in this space of, people often fall into the trap of like, well, if I'm going to hold a sound money asset, I might as well hold gold because it's proven. And like, that's going to be a better store of value and a more reliable. So if I'm going to do anything, I'll include a little bit of gold. But they're making this mistake, this fallacy of assuming that Bitcoin and gold are in a similar sort of point in their life cycle. And I think you're right to call out that, like, you want that end state stability in this asset, but that's not where we're at right now. Instead, there's a huge asymmetric upside opportunity as we get to that eventual place for Bitcoin, which is many, many, many trillions away in terms of monetization and total asset value. So, I think that's a unique lens that I haven't heard. And I think it's probably coming from your role in trying to communicate this opportunity to pensions of, don't think about that end state, think about where you're at right now. And the end state is where you'll eventually get. But the real exciting part is, the monetization process that Bitcoin is still at the very beginning of.
Yeah, I think that's right. I mean, we've got a saying in the investment community, which is variations on it, but the future is not necessarily a reflection of the past, or something similar to that. So the idea that gold's done what it's done over the last 5,000 years, I mean, it's obviously impressive, right? It should be given credit for that. But I can't invest in the past. I can only invest in the future. And so I need to look at, when advising clients, what's the future? What's the likely future scenarios that we can foresee or test out or envisage?
And also, Bitcoin in April is going to have a better stock to flow ratio than gold by a long shot, double the stock to flow ratio, right? So if you look historically at what's happened when a harder form of money entered a society, well, then all of a sudden that slowly kind of eats away at everything else. So actually holding gold is a risk, right? Because if Bitcoin eats gold's lunch, if gold becomes demonetized, you certainly, that argument of like, oh, well, if I'm looking for an asset that's a store of value, I'll just go with gold. What if in 20 years' time it's been demonetized and now it's an industrial metal, right? So you definitely don't want to be making the mistake of saying, I need a store of value asset in my portfolio. It's obviously gold, because that might be the worst thing that you can do. And then also, nobody's saying that the probability of Bitcoin doing that is 100%, right? But it's some percentage. I like to think it's quite a large percentage probability that it's going to do that, given Bitcoin's properties. And so if you give me 100 opportunities with high probabilities that they're going to come true and with huge upside, I'm going to take every single one of those bets or make an allocation to all of those things. The trouble with this is that you can't rely on the law of large numbers, because you've only got this one bet, right? But there's also the danger that, like we discussed, I think the last time, is that because everything's denominated in these fiat currencies, that essentially, I remember Marty joking about black hole insurance, right? Like Bitcoin acting like a black hole and like sucking all the value out of these other assets, because as it monetizes, that value has to come from somewhere, right? And and the biggest asset class where that's going to be the case is bonds. Another one is property. Probably the last one, if it would happen, would be equities, because there you kind of, I mean, essentially, because your revenue is going up as in nominal terms, you kind of protected. I mean, equity has been a good long-term, like inflation sort of protection kind of asset. Bonds definitely not. Properties overvalued, right? So it's, the idea that, well, if I want to store a value asset in my portfolio, I'll just put gold in there. Okay, so what are you expecting? A zero real return, right? That's what you're expecting. And at the same time, it gets demonetized. And how much of your portfolio are you going to put in gold, right? Whereas you can put 2, 3, 4% in Bitcoin, right? And it's going to have a material impact on the rest of your portfolio. So, and you, especially like with different types of investors, right? You can't afford to be using huge chunks of your portfolio as kind of a long-term store of value. You've got different objectives. You need to grow the capital, or you need to hedge liabilities or something like that. Whereas with this thing, it's just kind of like the sprinkle of salt, that you put on top of the meal. And you can get busy with everything else that you want to do with the portfolio and just have this thing there kind of.
Yeah. It's so interesting that you guys marry this, the first principle thinking that is necessary to understand the value proposition of Bitcoin, but through an actuarial lens, where you guys are evaluating this in terms of probabilities, numbers, and how this works out in different scenarios. And then finally having to filter that through the fiduciary obligations that you have providing advice to pensions, because of and specifically with regard to the mandates that those pensions have to take care of people's retirement money. And that combination is kind of unusual, I think, in the Bitcoin space. There's a lot of people who are in similar roles that we've yet to really find Bitcoin, but maybe whatever circumstances it was that you guys in particular had that allowed that combination of three things to line up just right to see it, to get it, and I think to solve such a big problem in pensions of, you want to have that sound money safety, but you don't want to set aside a huge portion of the portfolio to provide that protection. Because Glenn, you're right. With gold, you'd have to, if you want to protect the portfolio, you got to have like 50% of the portfolio in this asset that's going to generate no real return, versus 2, 3, 4% in an asset that can provide the same function of protecting in terms of the sound money properties that it delivers, because of the growth in this early stage in the S curve monetization phase that it also comes with. And that insight, I think, comes from the combination of those three lenses that you guys are bringing to the table, and that every other pension, every pension allocator, every pension consultant sits in the same role and has yet to really put together those dots. But I think that we're going to see a greater trend of that, because once you really understand Bitcoin, and that's the first principle, heavy lifting, that has to happen first, then the conclusion is this, that if you want, it's the most attractive thing to include in any portfolio if you have the right position sizing, and that's just 2, 3, 4%.
And so I think sorry, Sam.
I think there's something else that's needed as well as those three things you mentioned, which I agree with, all those three. It's willingness to think outside the box, or if I put it another way, the willingness to see outside the bubble. I think, we look across our industry in the UK and look at the actuarial profession and all that kind of stuff, and they're doing lots of hard work in lots of areas, and some of it's quite useful, but it's within a bubble. It's and you need to get outside of that bubble, and you see the bubble for what it is. I suppose another way to describe it would be a fiat bubble, and all the things that go along with that, that I'm sure you talked about before. But you've got to step outside and see it for what it is, and then realise that it's fine for that to be 98% of a portfolio, but you also need something outside of that bubble as well, and that's what gives you that diversification, being out, having something. The exact percentage almost doesn't matter, but having something outside the bubble.
And to build on this line of thinking, I think I do have a three-part question. How do we settle on this particular allocation, 2 to 4 to 5%, whatever it may be? What sliver of a portfolio allocation does it fall under? What bucket does it fall into? And then 3, at which point do you think it becomes abundantly clear to everybody that this is the strategy that needs to be employed, some sort of allocation towards Bitcoin? Maybe it's not even a decision that's made willingly. Maybe it's forced upon market actors via benchmark or something like that.
So, I mean, it really depends on the type of client. So if it's a corporate treasury, if it's a pension scheme, if it's a charity, if it's a funeral trust, it depends where they are in the investment journey. Do they have a short horizon? Do they have a much longer horizon? But initially, it's kind of like the first thing that you normally come across when you approach a client and you say, hey, I want to talk to you about this thing called Bitcoin, is they're like, isn't it too volatile, right? So when you're thinking about the percentage you should put in a portfolio, you're thinking, how much can I put in this thing without there being any sort of perceptible effect on the overall volatility of the portfolio, right? And what you find is you can kind of do rolling sort of 4 or 5 year periods where you kind of put 2% in, you back testing, right? And you're saying, would I have noticed the volatility both from a kind of a standard deviation or a normal volatility portfolio, or from a maximum drawdown kind of perspective in the overall portfolio? And if you put 2 in, you can't even feel it, right? You can't see it, you can't feel it. It's like, why wouldn't I do this, right? You put 3 in, it's kind of like, again, not perspective. Once you start getting to 5, right, then, because you find that, like, so for example, in March 2020, when they locked us all in our houses, right, everything becomes correlated, even Bitcoin, right? So, but Bitcoin's drawdowns are like, 60, 70%, right? So if you got 5% in a portfolio, it's about, it makes about 35 basis points difference to the drawdown, something like that. If you put it's about 3.5% of the drawdown if you got 5% in a portfolio, right? So that you start to kind of notice, whereas 2%, 1% extra drawdown takes no longer for the portfolio to recover to its previous high. It kind of feels like that point where you can kind of, everybody stays calm. You know what I mean? You don't want people like, especially when you're introducing an entirely new asset, an entirely new concept, all of these ideas and whatever, you want it to be at a level where everybody's like, 2% is sort of like the allocation that a FANG stock might have in a portfolio, right? Just one stock. So it's kind of like easy to, introduce somebody at that kind of level. Whereas if you start talking about higher allocations, it's a more complicated conversation. And you just want to kind of get people off zero rather than, asking them to do a lot more than that.
I mean, this may be sacrilegious for this show, but the right allocation for some pension schemes is 0.
Yeah.
And I think ultimately it comes down to time horizon. So if they're different types of pension schemes, you got DB and DC over in the States, as well as we've got the same over here. So DB actually, once it gets well funded enough, a final salary scheme or a defined benefit scheme, you can pass the whole lot over to an insurer. So actually your time horizon to invest is until you can afford to pass it to an insurer. And for some schemes that might be 6 months. Actually they won't even have any, particularly with the rise in bond yields generally, that has actually improved the funding position of a lot of final salary pension schemes. So a lot of them are in a good position that actually they just want to lock down as much risk. They shouldn't be having equities. They shouldn't be having any growth, which to your question, Marty, that's where it fits. It fit in the growth allocation for final salary schemes. And so you just want to move them across to insurance and low risk. And all you're trying to do, though, is make sure people get the pensions they've been promised. You're not looking to do anything fancier than that in a secure way as possible. However, there are other schemes where they might have 10, 15, 20 years to go, in which case then they do have some equities. They do have a growth portfolio, in which case then some kind of allocation to Bitcoin within that makes sense. And I think that's probably that's the category where it makes sense to get off zero.
That's really interesting that two very notable things you include there, that what the conclusion that you guys have come to is that this fits in the growth category of any portfolio. And I think I certainly fall into this this reflex, I guess, at this point of it's a sound money asset, it's a scarce asset, it's a hard money asset. It's its own thing, really. It's a 60-40 zero. Like that zero should be higher. You have your equities, your bonds, your hard money, and everybody overlooks that category. It should be its own thing. But you guys are cleverly putting it in a growth category. So you're thinking about it as a replacement for like a growth company stock, and that's very notable and informative for anybody who's trying to think about how to justify where to include Bitcoin in their portfolio. And then the other thing that I want to follow up on is, so makes sense that 6 month timeline, 6 month horizon pension scheme, Bitcoin doesn't make sense. It's too volatile. The possibility of like a March 2020 event is non-zero, and you can't have that. 10 years plus, the growth will bear out, if the thesis is right with Bitcoin. Where do you draw that line, though? Is it do you subscribe to a 4-year cycle is what you need to live through, or is it different in your minds?
So we've said the minimum is 4 years, right? So that, but obviously, if it's longer, it's better. Ideally, you'd want longer than 8 years, so 2 cycles, right? But 4 years at a minimum. I suppose it would also depend on where you started, right? So if we have a massive bull run now in the next 18 months, which is kind of what I guess we're all hoping and expecting, that, if then a client came to us, then would probably dollar cost average in, and would probably kind of do that, put in, would space the kind of entries wider rather than kind of doing them quite quickly. And if it's going to take like 2 years to get them in and they've only got 4 years total horizon, then it kind of doesn't make sense, right? So then you need a little bit of a longer horizon, because definitely, I think it's, we talk a lot about investor behavior and psychology and stuff. And with an asset like this, it's definitely going to bring out the greed, right? So we're going to have that blow off top at some point, and then it's gonna, crash to, a level which is much higher than the last time it crashed, right? But nevertheless, if you get in at the top, it's not gonna feel good, and it's not gonna be good for the portfolio. So I think like now, and we've even kind of said this in our communications to our clients, it's ideal. Nobody knows what the future holds, right? But it's ideal if you really like an asset and it's had a bit of a tough time, that's the time to kind of make an allocation, not kind of when everybody and their dog saying, I've got to get some Bitcoin, right? Then it's probably the time to say, okay, well, let's kind of, get in, but very kind of gradually and slowly.
We might be getting too much into the nuances, possibly, but I think it's not just what do you think the time horizon will be, it's also how certain can you be that it will be at least, say, 4 years or whatever number you pick. So there are, if you've got a defined benefit scheme that's taking lots of investment risk, you think the time horizon is 10 years, but actually you turn around 5 minutes later and equity markets have done really well and bond yields have shot up and they're fully funded, they can go to the insurance market straight away. Or they're close and the company suddenly has some cash and throws it in. And then you can go to the insurance. So if you've got these kind of uncertainties around the DB scheme, then it then creates uncertainty about the time horizon. So it takes a lot of thought to make sure that it's right for each particular scheme. And that's DB schemes in particular. And there are other types of scheme as well where I think it also gets quite interesting. And I think comes back to your point about sound money. So if we move to, like, say, defined contribution, we call them over here, or money purchase. So the company and the employee throw some money in a pot, and the pension is whatever it buys whenever that member retires. In that scenario, a small allocation can make a lot of sense. And in fact, often they're not buying an annuity at retirement, they're continuing to invest it. So actually their time horizon could be not just the 20 years until they get to retirement, but maybe another 20, 25, 30 years after then. So we're talking about a really long time horizon there.
Yeah, this is actually an important part because you're referencing the time horizon and whether it's explicit or implicit, because you guys fundamentally understand what's happening. I feel like you're educating beyond any time horizon and wanting them to think much longer than whatever's on their benchmark. I'd be curious, like, how you guys try to navigate that, because historically, like, institutions have been effectively exit liquidity for the system, right? They see it running and then that's when they get in and then they're burned and they're like, what did I do? And so that has to be at the, in the back of your mind as you guys have been educated. And be curious, how have you thought about that and try to get in the underside of something we think about a lot at Onramp. It's about these institutions are made up of individuals. And so it took you going through 2008, took Glenn having his background. We'll maybe save that one for beers. I don't know if we need to discuss publicly how he got to be the way he is. But this idea of it starts at an individual, and it feels like as much as it's talking to the pension, it's also the individuals that are there and helping them see it. Anything you guys can share there, I think, is helpful, because there's a lot of people that listen that are having these conversations across the board, whether it's family members, their treasury at institutions, and they're all trying to figure out what is the right, and there's no silver bullet, but you guys are navigating this in real time. So anything you can share there would be nice.
Yeah, sure.
I mean, so it's always interesting, right? Because there's that moment where you say, okay, Bitcoin could be right for this client, and now you've got to contact them, and it's usually an email, right? So you've got to kind of, in this email, say to them, I want to talk to you about Bitcoin, right? And I've been pleasantly surprised, right? Because I would say 9 times out of 10, they're like, okay, let's have this conversation. I think maybe what it is they're like intrigued, interested, just curious, want to learn more, right? there have been instances, like with a head of corporate treasury, where we contacted him and he sent us back a chart of Bitcoin and said, look at this thing, it's so volatile or whatever. So then we sent him one with a logarithmic price axis saying, actually, you should think of this as like something in the adoption phase, and that like, you want to look at percentage changes in the price, and you can see in that logarithmic kind of price curve how it's slowly being adopted over time. And then he came back and he was like, we don't want anything that isn't backed by anything or something like this, right? And so you don't always win, but 9 times out of 10, they're willing to have the conversation, right?
Well, the important thing there is that he didn't just ignore your email. He came back with questions. So I think that's where a lot of people are at. Everyone goes through their own journey in learning about this. And sometimes that'll be, what do you mean it still hasn't died yet? Yeah. And that will get their interest. So it is quite interesting how different people will take different routes in there. And I think whilst we're in the monetization stage, which could be, who knows?
A couple decades maybe.
Could easily be, yeah. But equally, no one knows. So things could happen. Actually, I find quite interesting the impact something else can have on itself, sort of in a circular way. So actually, it might speed up the adoption of Bitcoin because it exists. I know that sounds a little bit circular, but that's sort of the point. In that, because there is an exit route, it means that people run faster towards it, which then leads more quickly to the collapse of the existing system into Bitcoin. So I've seen some people say, well, it could take 3 generations, and that's to do. And it makes sense. It's about people. It's the psychological way that people think about these things, and are they used to it, and so on. But I suppose, I'd like to be alive for the end of it. So, in some ways, quicker the better.
I was thinking about the point Sam's making about it maybe happening, like Parker Lewis says, gradually, then suddenly, right?
Right.
You remember when it was like March last year when all the banks were kind of in trouble and Credit Suisse basically went to the wall. And I remember, I can't remember if it was on this podcast or one of the other ones, Marty, where you showed that chart where the bank stocks all like going down and then at exactly the same time, Bitcoin going up, right? And we've been looking at like setting up corporate treasurers with access to Bitcoin and actually having software to kind of plug into the normal corporate treasury systems and stuff. And the company that we're talking to who's got the technology to do all of this stuff, like kind of told me without mentioning names, they've already got like companies with more than £1 billion in Bitcoin, right? And so like I was thinking when that stuff was going down, like imagine you're a big company and you've got like a few million in cash in the bank, right? How do you get it out when, the proverbial's hitting the fan? What do you do? Like go and say, please give me like, big, I don't know, briefcases or something full of cash. I want to get it out of the system because I'm afraid, right? But with these kinds of systems, you can just say, just buy Bitcoin with it. And now you're entirely outside the financial system, right? There's no way that anybody can debase it. No one can, there's no kind of...
Outside the bubble.
Outside the bubble, right? And so I wondered if that is what caused, because there was also this VC guy,
Silicon Valley Bank.
Yeah, and he put out this note to all his investee companies saying, buy some Bitcoin for situations like this so you can still make payroll and all this kind
So I
of stuff.
think so. That's one of the things that quite interests me is this sort of escape route idea. So, and I suppose, so in corporate treasuries, for example, if they've got a small amount in Bitcoin, they've got the infrastructure set up to then make a quick allocation if they need to. If they start from scratch, it's not going to be 5 minutes to get their money out of the banking system or some of it, or, just to reduce their reliance on certain banks or whatever it might be. So that escape route for corporates, I think, will be really important going forwards. Escape route for individuals. So in particular, we're investment advisors and employee benefit specialists. So we can, there's loads of interesting things going out there, but we can only focus on what we can do, what our skill set is. So on employee benefits, what we're trying to set up is a Bitcoin employee benefit system, or ability to do that. And one of the reasons I like that is because it gives individuals an escape route. It also, if you've got no exposure to something, you've got limited interest in learning more. If you've got, even if it's only £100, $100, whatever, you're interested in it, disproportionately so. But you're more interested in it, and therefore you'll see the headlines, you'll read more reports, you'll maybe read the odd book.
Yeah, one thing, just to anchor, like, this is common practice from business continuity. When that Silicon Valley Bank, I was with Marty that weekend when it was happening. I remember it vividly, thinking about, like, holy crap, like, they have to figure this out by Sunday, because it was just going to be anarchy on Monday, and they did that Sunday night. But it's this idea of, like, you gave enough people the time to think about, what if I don't make payroll? Like, what are all those things? It's almost negligent not to have some capital outside, and everybody has their own balance sheet, whether it's an individual or a business. And so to have those rails, even if it's a River account in the US or a Coin Corner account in the UK, and maybe start playing around like you're referencing, it's like, this isn't a conspiracy that the banks just, like, have not given people their money. It's true. They shut them down. There's no question about it. And so to not question or think about what is your options, whether it's a pension or an individual, it's almost just like, at your own risk at this point.
I think we are seeing live the flipping of the previous view, which was, I don't want to go anywhere near Bitcoin. It's too volatile. I've got a fiduciary duty. I'm looking after other people's money. It feels like gambling. And we're sort of in the process, in the middle of flipping to a situation where it is actually irresponsible not to consider it. And the quicker that spreads, the better, I think, because we want to protect our clients as best we can from these risks, and they're big risks out there.
We were talking to trustees of a funeral trust, and what happened was they got into this sort of quite tech-heavy equity fund at the end of 2021. It was kind of like the beginning of their investment journey, right?
To peak.
Yeah. And then it literally, like, crashed like 40% on them, right? And then they're, like, kind of lay trustees. They're not, like, investment savvy. So they were like,
It's like
this is too much.
Peloton's like peak 2021.
Yeah. And then they were like, okay, we want our money back. So they took it out, right? And then they put it in the bank. And which bank did they choose? Metro Bank. And Metro Bank ran into trouble and had to get recapitalized, right? But there were a few days there where the money was in the bank and they didn't know if the bank was going to be okay. So that was kind of like their experience was...
They took the 40% haircut, and then they might have taken the rest of it if they didn't fulfill them.
And it's like a whole fiat adventure, right? Because you, like, put interest rates at zero, print a whole lot of money, hand it all out, right? All these tech growth stocks go through the roof, right? Then inflation roars, then you raise interest rates, then they all come crashing down again, right? Then you have all these banking crises and whatever. It couldn't be more obvious that you need something like Bitcoin.
Glenn, you got to be careful. You're going to get Marty all riled up.
Well, I'm thinking back to last March when this was all happening. We had a number of companies in our portfolio, 1031, that were exposed. I mean, the Bitcoin industry as a whole was probably the most exposed because of the lack of access to banking relationships and banking relationships that did exist. The banks that failed, Silvergate, Signature, Silicon Valley Bank, First Republic, like those were top 3 banks, the first 3 for the industry. And so people were moving quickly, and a lot of them were buying Bitcoin and putting it in something like an Unchained Vault or holding it on River. And I think it's important to highlight here too, like, yes, you eliminate that third party risk as well, but diving back into like the long-term strategy, there's also, it's an exit from this third party risk. But if Bitcoin does what we think it's going to do, particularly in the context of something like a venture-backed company, it could extend your runway into the future. So you start by allocating to Bitcoin to eliminate that third-party banking risk that exists. You hold Bitcoin on your balance sheet, and then the price runs, and you wake up 8 years from now, like, holy crap, my balance sheet is 5x'd, or the Bitcoin portion of my balance sheet is 10x'd, which has allowed me to have significantly more runway. And you can apply this to a pension or any type of fund, for that matter, in the future.
Yeah, it goes from being defense to offense really quick.
Yeah, you get a lot when you buy Bitcoin. You're not just getting gold. You're getting gold plus growth, plus something that sits outside of the bubble, outside of the system, and benefits in the event that there's trouble in the system. And and plus you're getting you're buying a stake in the Internet of Value in the early days of the second part of the digital revolution, in my opinion, to complement the Internet of Information that we already have and assume is everything, but it's actually half the story. There's so many things that you get when you make an allocation to Bitcoin. And I think that's part of, like, when you guys are running it through your actuarial tables and seeing, like, if this is 2 to 5%, not only is the volatility acceptable, but you get all this incredible performance out of it too. It becomes something that, so long as your time horizon is long enough, it becomes a bit of a no-brainer, really. If not a no-brainer, then at least a hugely asymmetric upside bet.
Yeah, and what are we trying to achieve for our clients? We're trying to maximize the return for the same amount of risk, or we're trying to have the same return and reduce the risk. You want assets with this kind of risk profile. Not all, but you want a bit. And that's exactly what we're talking about.
Thanks for tuning in. If you're interested in exploring any of these topics further, or want to learn more about how we can help you secure a new or existing Bitcoin allocation, get in touch with our team at onrampbitcoin.com. We look forward to supporting you on your Bitcoin journey.
But Glenn, I don't invest in crypto. I don't invest in crypto. What do you guys say to that? Because that obviously.
Neither do we.
Yeah, we don't either. Yeah.
I would imagine that's the response, but can you expand on that? Because that's something we obviously get a lot when we're doing outreach or having discussions is I don't invest in crypto. And
so right up front, whenever I talk to people, I say everything I'm going to be saying today is not about cryptocurrency, right? We need to make a distinction right up front so that you don't make the mistake of me talking to you about this asset and you going away and thinking I was talking to you about cryptocurrency, right? I was not talking to you about cryptocurrency, right? I told them, if you hear any of these terms, NFT, Web3, blockchain, crypto, right? I am not talking about those things. And I suggest very strongly that you stay away from them, because at best, they're sort of .com companies, if you want to be generous and, kind about them. But in reality, the very vast majority, if not all of them, are scams, or there's some kind of way that the banking system or whatever is going to kind of co-opt them, and you're just going to have the same thing over again, right? With blockchain, private blockchains or whatever, where they essentially like, oh no, it's all safe because it's a digital ledger and whatever, but there's only like 3 nodes on this ledger. And when they get into trouble and they need to bail the system out, they'll just create a whole lot more digital tokens, you know? So I would try and kind of separate.
And then 3 hours later, we start the presentation.
Yeah, but you know, it's like kind of making it clear that like there's. I also like to say to people that all of this other stuff is just people copying Bitcoin. That's all they did, like, right? And so the only real thing here is Bitcoin, right? Yeah.
And if you view Bitcoin as far out on the risk curve already, just by looking at just a pure market cap comparison, you'd have to be even crazier to allocate to broader crypto. It's way further out on the risk curve compared to.
So it actually helps. It actually helps, Marty. It helps that our clients are more cautious, as they should be, because they're looking after other people's money. Because then you've got, cryptocurrencies, and then you've got the one, which is, obviously there are ones that came before it. It's sort of known as the first, isn't it? But there were ones that came before that. But it's the one that works and has the press and the network effects and all the rest of it. So if you combine that, and then we can help them through the sort of what is money angle, and then it's really, it's the perfect money as long as it doesn't get killed. So it's all about, so it's like the perfect asset for someone to do it. You got to assess what are the chances of it getting killed. And if you can get comfortable with that, I haven't found anything convincing myself yet, then it doesn't matter. Nothing else matters. So that makes it a bit easier.
Yeah, in that sense, it's the perfect asset for everyone to be holding, and pensions in particular. Sam, you touched earlier on how I think this that my understanding of it is correct, that for defined contribution plans schemes, it can be a little bit easier to justify this type of asset versus defined benefit plans. And to me, it's almost a shame, because I don't know if I assume it's the same in the UK, that here in the US we have a lot of underfunded defined benefit plans, and the US government in particular has a huge burden of unfunded liabilities into the future. And from my perspective, I don't see any asset that helps close that gap except for Bitcoin. And I think that Bitcoin could be the only thing that saves a lot of these underfunded defined benefit plans if they can wake up to it fast enough and see the value proposition, which most of them won't. But the opportunity is there for those who can. Any thoughts on that?
I think you're right. I mean, I think the underfunded schemes, by their very nature, will tend to have a long time horizon, because you expect it to take a long time to pick up the returns from equities or whatever other growth assets you've got. So they would naturally fall into that category of having a long time horizon, and therefore should naturally fall into the category of a small Bitcoin allocation. Makes a lot of sense. So I'd hope that a lot of them pick up on that, because we are going from one era to another era, I think, for lots of different reasons. But one of those eras is moving, and we have been doing it for the last 10, 15 years or so, is moving away from the defined benefit pension provision. Certainly the UK, I don't know enough about the US. And in some ways that's quite sad, because that industry provides a huge amount of certainty and benefits to a lot of people. It is not perfect by a long shot, and you're relying on sort of a lot of investment complexity to try and beat your bond returns, beat your inflation to provide those benefits. But then that's where Bitcoin slots neatly in. There's been a move to the money purchase, again, over a similar sort of period as employers stop providing DB and they start providing DC. And that is a natural step. I think a flawed step, but I think a natural step because it's the company saying, I can't take this risk anymore. I need to pass it on to the employees. But the trouble then is the employees are taking on the responsibility of investing. So in fact, I think there's a video with you sitting next to him, Marty. There's a great, I think you said it a few times, Saifedean has talked about how not having a proper savings, he says it much better than me, by the way, but it's along the lines of, by not having a proper savings vehicle, it forces people to invest. I think it also forces people to spend because they don't know what else to do with their money. And people are then trying to understand stuff which, it's very, very complicated. It's complicated for a lot of investment professionals. And the whole idea of you go to work, you do your job as a doctor or a teacher or whatever it is, and then you've got to come home and you've got to be an investment professional in the evenings just to retain the money that you've earned. It is ridiculous. And that was... I guess there's a few things that I suppose really struck me. So I mentioned the bubble. I suppose I was thinking of Jeff Booth when I was thinking about that. And Saifedean saying that about the investing and savings and having, effectively, you need to have two jobs to keep the money you earned. And I think that ultimately the truth will out. So if markets can be distorted for a long time, and I'm not just talking financial markets here, I'm talking about pension provision markets, can be distorted for a long time, but eventually the truth will out. And the truth is that if you've got an asset that is the perfect money and doesn't die, and particularly once we get to the second stage, which is just track roughly, obviously it's not perfect, nothing in life is perfect, of course, it essentially tracks economic growth, then that is like the perfect asset to have in a world of uncertainty that we all live in and we're never going to get away with. That is life. So I can see, we could be many decades away from that, but I can see a scenario where the truth comes out through of DB and DC and some of the hybrids that are being created, which are even more complicated than either DB or DC, to try and mitigate some of the risk. And then you end up in a position where actually most employees, they want to go to work, they want to just focus on doing a really good job, they want to take their salary, and maybe some of that is in Bitcoin, maybe some of it is in the local currency, whatever, that will depend on the situation at the time. And that could easily be where we'll end up. Now, there's a huge amount of vested interest to get through before we get to that stage, because you don't need a lot of investment advice to be able to do that. But, as I say, ultimately the truth will out. And I'd much prefer to be on the right side of history than to try and artificially keep the existing system in place or be part of that.
Yeah, and Sam, I think I agree with you. I think this is going to happen much faster than people imagine, because you have all these forces at play, whether it's the macroeconomic headwinds that are going to just hit markets globally. Like it is becoming abundantly clear that the Fed's rate hiking regime may be coming to an end. We had Jerome Powell on 60 Minutes last night saying it's probably going to happen. It's definitely going to happen at some point this year. You have the increasing knowledge of Bitcoin and understanding of Bitcoin globally, and then you have these systemic problems that exist throughout pension systems, fund systems, whatever it may be. And once the cat's out of the bag, people realize this, and they start flooding in, there's not going to be any turning back. And this gets back to the point at which Bitcoin becomes like a benchmark that forces pensions to allocate, which forces them to sell positions in other parts of their portfolio to buy Bitcoin, which hinders their performance, the assets that they're selling, and I could see just a crazy feedback loop, a sort of virtuous cycle to Bitcoin monetization happening rather quickly. And then on top of that, you have all the social developments in terms of people being more aware of inflation than they have in multiple generations, and understanding that the institutions that are supposed to have our backs and look after us, whether that's the government, the media, big pharma, the banking system, are corrupt at their core. And I think there's this incredible culmination of events happening to produce an inflection point that sort of slingshots Bitcoin to the reserve asset of the world. I would say in less than 15 years. It's funny because, Jesse, you said it's going to take decades. We're already a decade and a half into this. I think from launch to reserve asset would take like 30 years, one generation. That would be 15 years from now.
And Sam said 3 generations, which is also possible. I mean, anything in that range would be incredible.
I mean, one thing to add, though, Sam alluded to is this idea of that you referenced, Safe, about people don't have a good form of money, so their habits. And that's the scary part and the pervasive part of it. It may take longer because that's like a psychological thing, and the way it manifests now is you need your yield. So like getting somebody into Bitcoin is only like half the journey, right? Maybe a little more, but then there's this idea of like the Bitcoin is the yield. You don't need to do anything with it. And we know how many people in 2022 and 2021 don't have any Bitcoin anymore. And that's going to be that's already a distant memory. So the next cycle we're going to see, I think if we all probably agree, we're going to see, the animal spirits again. And so this idea is that it's an asset, but you're a sucker if you don't do something with the asset. And that's the concern of like, does it happen that fast? Because there's an education that goes in. And the thing that's really like, it's kind of the annoying part of all this, and Sam, you alluded to, it's like this reality of getting to the other side of like, you just do what you were supposed to do, whatever it is that you were given from a like skills perspective, and the money just protects you from it, is a very like long thing to pick up. And so most people are like, what do I do with it? What do I got to go out? I got to trade it. Even Bitcoin, like the whatever appreciation year over year. And so that's the kind of part that I don't know if it happens as fast as we want it to, because it's still a psychological thing that you just like hold it. You don't go and do something else with it, because that's where you end up losing the asset.
I think it's what it is it's not so much about Bitcoin, it's about the rest of the system. So in the UK, we had like, in the way the government likes to measure inflation, 13%. I don't know if you guys have seen this website, Trueflation, where they kind of like create their own inflation baskets, right? And they call it 20%. Actually, there's no real inflation rate because it depends what you put in the basket, right? So it's different for everyone. But the thing is, everybody felt it in the US here, right? And so when those kinds of big systemic things happen, right, and everybody's like, hang on, what the hell's going on here? That's what I think more of that can make the Bitcoin adoption happen faster, right? Whereas if they're just stealing kind of 2% or 3% a year, then it's going to take longer, And I also think that because of the 4-year cycles, you're going to have these kind of waves of adoption, right? So like with each new cycle, you'll have like the people that kind of FOMO in at the top, right? And then it crashes, and half of them, or probably 80% of them, don't stick around, right? But you got kind of this next. But I think what can really speed it up is because I think it is a very real possibility. Like we were at a investment manager, an LDI, a liability-driven investment manager, the other day. They were talking to us, and there was this one guy who all he does is, well, maybe not all he does, but he just looks at like interest rates and inflation rates and swap rates and all of this kind of stuff. And he was basically giving us his kind of analysis of where the government is and how many gilts or UK government bonds they're going to have to issue. And I've seen similar analyses in the US, and like the imbalance between demand and supply and, you know, all of this kind of stuff. And I think we could see a huge kind of a financial crisis in the normal system, you know. And then it's sort of like the response to 2008, but this time Bitcoin exists. And then all of a sudden it sort of bursts into the consciousness of the masses.
Yeah, we need to be careful there, don't we? Because we're not saying that Bitcoin is the reason for the existing system to implode or explode. It's going to do that anyway. What we're talking about here is how can the least number of people be harmed when it does blow? And you know, whether it's productive companies or whether it's individuals, from a sort of a philosophical point of view, I want as many people to be unharmed as possible. And the way to do that is to have some exposure to Bitcoin. The way to do that is to have an escape route, to have learned about that escape route. And yeah, no one knows the exact timing, but to be ready.
But actually, so that goes back, let's go pre-Bitcoin, because this goes back to 08. Can you walk through, like, I think, and correct me if I'm wrong, you came to this realization before Bitcoin about the system and the inevitability. Can you walk through, like, I think most of us, I mean, we're, at least on the pod that come on regularly, we were very young, you know, to like have a full, obviously understood something was not right, but to know that it was a system that was, you know, bored into and you have to pay taxes and go into. But explain like what your realization was in that.
Yeah, so it was a realization that there was too much debt, the way that money was created, you know, fractional reserve banking, but also from the central bank, and sort of how that system operates creates certain vulnerabilities to the system as a whole, which is why we get business cycles and all the rest of it. So it was an understanding of that, and I suppose it was sort of realization that it didn't seem to be widely realized, which is why the whole system was kept relatively together. I suppose it was gold was the obvious escape route in those days, and obviously it was fairly well publicised. But even then, that didn't get, you know, huge inflows. What was the second part of your question? I was desperately that's the problem with two parts.
You know what it was for me, right? Was that it was like, so you're an investment professional, right? And back then, so at Cartwright, we think very long-term strategic. So we're not really thinking about tactical asset allocation or anything like that. We're thinking, you know, 20 years or whatever. If it's short horizons, well, then we're basically not in growth, right? We're just matching liabilities. But back then I was working, and I've worked at a number of firms where we were thinking more tactically, more kind of short-term, right? And for me, it was the realization that no matter what analysis we do, no matter, it's all meaningless, because at any moment, the central bank can just pull out a massive money bazooka and make all of our analysis meaningless, right? So it was like the right thing was not to be invested in this or that or whatever. And then all of a sudden, they just make us look like idiots, because all of a sudden, everything goes, you know, rocketing up because they've just kind of debased the denominator.
It was the whole risk on, risk off, depending on what each central bank said at that particular moment. I mean, it was a little bit silly. I like Marty's optimism, if I can call it that, the 15 years. I think the mistake I made in 2008 was that the financial system cared at all about what I thought or when I thought it. So the mistake I made was that I've just found out all this stuff. I thought, oh my goodness me, I didn't realise this is how the system works. This is going to fall apart. It feels like it should fall apart tomorrow. But of course, it's clung together for, well, over 15 years, actually. So will it cling together for another 15 years? So I think I'm a lot more sceptical about my own ability to predict timing on these things and hopefully get the direction roughly right.
I mean, it's also like quantitative easing, right? That was kind of the first time that I was like, what is this thing? Okay, I've got to figure out what this thing is. And then you figure out that they're just creating money out of thin air and, and then buying. It's like, hang on, like I spent 4 years at university and then another 3 becoming a chartered financial analyst. Nobody told me this was going on. You know what I mean? And then you start to question everything that you've learned, right? And yeah.
Yeah, in the actuarial exams, no mention of the Austrian School of Economics at all.
Yeah, and no mention of the money bazooka that changes everything. And so you guys were living through this experience in 2008 of like, wait a second, all the value investing that's based on like actuarial math and actual numbers of like what are future cash flows and what's that worth in terms of PE ratios. All of that goes out the window if suddenly there's a money bazooka and risk on, risk off is all that then matters. Is the bazooka turned on? Is it bazooka turned off? That becomes all that matters for portfolio construction.
Well, that's only one facet of the manipulation is the money bazooka, which is a massive manipulation. But then, like going back to 2008, like another form of manipulation was the rating agencies. Like you could make all the actuarial analysis that you want to based off the bond rating of the commercial-backed mortgage or commercial-backed securities you're buying. But at the end of the day, if you have one stakeholder in that flow essentially lying, which the ratings agencies were, it just completely borks your models, no matter how good of an actuary you are.
Yeah.
Good film, that, The Big Short.
Yeah.
Yeah.
I remember going to an interview at S&P where, I started my career as a bond trader, and then I worked at a investment consulting and investment technology firm, American firm called Wilshire Associates. And then I wanted to leave there and I started interviewing around. And one of the places I interviewed was at S&P to rate CDOs, right? And this was before the 2008 financial crisis. And I always remember that interview because I would have been one of the guys at S&P rating these things full of subprime mortgages
AAA.
as AAA, because we had like basically kind of had all these tranches of, and they had CDO squared, so CDOs that held CDOs and just crazy stuff. I mean, like, how can you not look at all that? And you got into this industry thinking, I'm a clever guy, I've learned all of this really important stuff, and like now I'm gonna go and add value and kind of use my brain and all this knowledge and stuff, and then all of this stuff just makes a complete mockery of the whole kind of thing, because basically just buy anything because it's better than having the money in cash, right?
But it's worse than that, isn't it? So I only know about the rating agencies from watching The Big Short, so I don't have any inside information there. But if The Big Short's correct, then it was pretty awful. But it's more than that. It's by changing the interest rate, you're manipulating everyone's economic calculations and creating these boom bust cycles and creating these periods of hardship and distorting. So we wrote Glenn, we got someone else to write some of it, and Glenn wrote some of it. We're most of the way through a series that we're running through, a series of articles called What is Money? So what we realised was that we could go out there and try and talk about Bitcoin, but actually we've missed a stage. Because most of industry is very happy talking about equities and bonds and property and all the rest of it, but don't actually understand what money is. And so we felt that actually it needed some education there. So we've got 10 articles, haven't we? So 7, I think the 7th one comes out later this week, 3 more to come. And it steps through various different things which you'd expect us to, I can't remember them all now, but one of them is the Cantillon effect. For me, that was when I learnt about that however many years ago, I thought that was absolutely fascinating in terms of how that works, and just another distortion of what happens when you mess with the money and who benefits and who doesn't. And it's not a value judgment. It's for each individual person should. What's that?
It's an essay on economic theory by Richard Cantillon.
Wow. Very good.
Cool.
So it's, each of these articles and each of the underlying theory behind them, they're not value judgments. It is for each individual reading them or, in their daily life to make their own judgments. We're not saying that they should be thinking in a certain way. What we're trying to do is say, look, there's some information here which you may not be aware of. It is up to you what you then think about it. And some people may be happy with those distortions or manipulation of money flows. Other people will not be. So we're going to have a variety of clients with a variety of views.
The one we're putting out this week is how modern banking works, right? And so again, we're not telling people what to think. We're just telling them some stuff they might want to know, and then they can make up their own minds, right? So, do you realize that when you put the money in the bank, that they're not keeping that money? In fact, they can give it to other people, and they can create as much money as they want, subject to demand given interest rates, because the reserve requirement is 0%. There's no such thing as fractional reserve banking in the UK and the US, because that fractional reserve implies they've got to keep a fraction of the money that you put. They don't have to keep any. So just be aware of that. We're not telling you what to think about that. Maybe you think that's a good thing.
Right. And that change happened in March 2020. And it was a temporary fix to provide liquidity to the markets that 4 years later we still have.
In the UK, they did it in the late 90s.
Oh, really? It's been that way for that long? Wow. Do you guys feel like you're a little bit of a canary in the coal mine then, with everything that happened with the gilt market recently and the intervention that had to happen to stabilize things? A little bit more volatility over there.
Yeah, well, it was so misreported, that whole thing, right? Because it was the pensions would have gone bankrupt, right? We were like, no. The best thing that can happen to a defined benefit pension scheme, which is the large majority of where the assets and liabilities are in the UK, when yields on bonds go up like that, it's great for the defined benefit pension schemes, right? And actually, because with liability-driven investment funds, you're using leverage, right? So it's like when you're hedging the interest rate risk using leverage, you need to meet collateral calls as the price of the bonds falls and the yields rise, right? So that's where the issue came. But the thing was, then the Bank of England kind of stepped in, right? So everybody got knocked out of their liability-driven investment funds because they couldn't meet the collateral calls quick enough, right? And then once they'd all been knocked out, then the Bank of England comes in and buys a whole lot of bonds and drives the yields back down.
That was the problem. It'd been absolutely fine otherwise. Actually, a lot of pension schemes were licking their lips saying, this is awesome. I can buy bonds even cheaper. And I want more bonds. And if the Bank of England had come in and said, we're going to I think yields were about 5%, maybe just under 5% at the point in time. If they come in and said, we're going to cap yields at 5% or 5.5% or something like that, then actually it would have been all right. It would have played for time, because the problem was when you got any leveraged fund, you call for cash, you need at least some time to get cash from A to B. That was the difficult bit. So if they just capped yields, they didn't. They just said, we're going to come and buy some. So massive, as Glenn says, I mean, it's so frustrating how you can have such a big player who does not understand the market or how it operates, and think the worst thing is they think they're helping. That, I mean, unbelievable. So the proof that they were not helping defined benefit schemes is that, I'm trying to remember the numbers now, something like they bought bonds particularly in October 22, and they bought around 19 billion pounds worth of UK government bonds, and that drove the yields down by 0.5% or 1% or so. The plan stated by them, to be fair, was that they were short term, they would sell them back to the market. So they bought them for 19 billion pounds. They sold them for 23 billion pounds. So they made a profit, which goes back to the UK government because of the way it's structured. So
At the
we've got to ask
expense of the
ourselves,
pensions.
where does that 4 billion come from? So they basically manipulated the market to take 4 billion pounds from UK pension schemes. There'll be some other entities involved in that as well somewhere, but we're talking primarily UK defined benefit pension schemes, and then they think they're helping.
And then,
Unbelievable.
and then the newspapers, I don't know who told them this or whatever, their story is the Bank of England saved the pension schemes.
This is your life on central planning.
Yeah, that's definitely the headlines we got over here. It's almost as if when you're adding additional intervention into a market, it causes problems.
Amazing, right? If only someone had thought of that before.
Yeah. No, because like when the Soviets did it in Vietnam, it clearly works very well.
Yeah, it worked great.
Yeah, the more you do of it, the better things go. So, yeah.
And I wonder for the pensions that do come around and adopt Bitcoin and allocate a certain portion of their portfolios to it, does Bitcoin's performance give them ammo against the government that may want to stop Bitcoin or intervene to say, hey, either this is really helping us, you cannot ban this asset, or try to prohibit its proliferation. It's literally helping us fund pensions of the individuals that live in this country. And then number two, like, hey, we don't need your help. We found something that's doing really well for us. Just leave us alone. We've got this figured out. You central planners don't understand. We don't need you.
I wish that was true, but we're not at that point yet where they kind of like, that's my view. I know that's your view, Marty, but I don't think they're just thinking of it. Oh, okay, well, we could get a really good return out of this thing, but they're not looking at it as a way to hold the government to account and say, hey, if you keep doing this, then we're going to do that. Or
what about the cousin of that in the sense of like BlackRock and the SEC and large bodies approving it? How is that influenced? Have you seen any movement or just interest?
I mean, when I mention it to people, so we've kind of we have investment monitoring reports that go out every quarter, and in there we call them hot topics. Okay, so it's like 3 things that we want to get out to our client base, and in there we did a piece, just 200 words, saying that the landscape of investment has changed because of the ETF launches. And, we mentioned BlackRock, Fidelity, Franklin Templeton. Why? Because these are brand names that they know and that they trust. And so it's sort of like, and when I've had conversations with people and I've mentioned the ETFs, or everybody that I've had a conversation with is aware that this happened, right? So I think that's kind of confusing people, because it was like, every time I read about Bitcoin, it was used by criminals. It's bad for the environment. It's a Ponzi scheme. The government's saying stay away from it. Da da da. And now BlackRock and Franklin Templeton and Fidelity have just launched these ETFs. So it's like kind of like, now I don't know what to think, right? So I think that's helpful, because yeah.
There will be an inflection point at some point in the future, though, I think, to which is helped by the BlackRock ETFs, and I think to Marty's point as well. So each pension scheme, each pension scheme trustee board must think only of their scheme. They can't think about wider than that. It's looking at the investment advantages, disadvantages of having small allocation, etc. Right? So that's what they must be focused on. Otherwise, they're not carrying out their fiduciary duty properly. However, I think there's a wider point that the more pension schemes that do this for their own reasons, but the more widespread it is, the more it is difficult for then the regulator or the government to act, intervene, I suppose, in some way, because they are hurting. They're hurting, whether it's the companies that sponsor those schemes or the members. They're hurting them by taking that kind of interventionist action,
which are effectively their constituents. They're people supposedly voting for them.
Yeah, exactly. So you'd hope that the voters would recognise that.
And this ties back into the Bitcoin employee benefits, right? Because if you're a member of a defined benefit pension scheme, and the scheme rules say you get inflation as the government measures it, or they can stipulate it in the rules. They can say the retail price index, the consumer price index, you get that, but only up to 5%, right? If it's higher than 5%, you don't get the rest, right? But also the 5%, is that even real, right? So the defined benefit, the sponsor, the company behind that scheme, is only on the hook for the rules of the scheme, right? But the members are relying on that for 30 years of retirement, right? And so if real inflation is 10 or higher, and they're only getting 5 of the sort of metric that the government's come up with or whatever, they could be 5% poorer every year. You compound that over 30 years, right? All of a sudden it's very nice having a defined benefit pension scheme, right? But it's not, near the end, it's not going to be nearly as good as in the beginning. And so even if we put Bitcoin in a portfolio, we're really only helping the company, the sponsor, because they're only on the hook for the rules of the scheme, right? So you want people to have access to this thing outside of their pension to make up for what's going to happen to
think of it as a 2%, right? So it's just to go back to that 2-3-4%. Maybe if we end up in a position where they've got most of their pension provision, at least over the next few years, most of their pension provision through DB or DC or whatever it is, and then 2-3-4% outside. Actually, that's probably quite a healthy position for a lot of individuals.
I agree. I think to your points about it accelerating, or almost it feels like it's accelerating in the sense of like high net worth individuals. I think of my mother-in-law who retired, and I always like egg her on, because every year I'm just like, you have less retirement, and like you can feel it. You go on vacation, it costs X. It's not 5%, it's 10 to 15, if not more. So you start to look at like, okay, I had this defined amount, and it historically was enough because it was 2 to 5, and you felt it. Now you actually start, and that goes across the board, and that's not slowing down. Since 2020. That's just exponentially increased, given money printer.
Exactly. I mean, it's quite funny. here, so the inflation-linked gilts here, they used to be linked to RPI. Well, they still are linked to RPI, but I think it's 2032 or 2030? They're changing the thing that it's linked to CPIH, okay, which is Consumer Price Index and housing. And then if you look at the level of RPI and the level of CPIH, of course CPIH is lower than RPI, right? So, but it's like the story is, no, CPIH is a better, more accurate measure of inflation. It just happens to be lower, right? You know what I mean? So it's like, it's like you think about these things like a logical human being and you're like, come on.
We just need to look at ribeyes. Like whatever the ribeye is, it's a pretty good index.
Oh, that's my basket.
Yeah, it goes back to, Glenn, what you were saying earlier of like the 4-year cycles. It sort of cause people to go through their own steps of the adoption process, and maybe you get in at the top in one cycle, but you learn, and then the next cycle you DCA, and then suddenly you are building a position and you're becoming a Bitcoin adopter, like in earnest. And every individual goes through their own process, and that also extends to organizations and to pensions, who are made up of individuals who are decision makers and folks like yourself who are providing advice to these organizations. But everybody in the world is going through their own adoption process, and it's a series of steps where at first you ignore it in 2013, then 2017 you're like, dang, I should have gotten some, and then 2020 happens. They print a bunch of money. You're like, I don't know, this feels wrong. Or Sam, in your case, Russia's foreign exchange reserves get seized, and that becomes like, all right, there's something wrong here, and I need to take Bitcoin more seriously. And then, of course, going into the future, there's not only the guaranteed mechanics every 4 years of the next halving, causing increasing scarcity, causing the next price run, or the next supply-demand price disequilibrium that forces a price discovery that causes a price run, and people pay more attention to Bitcoin for that period because that's how human nature works. There's that guaranteed to happen every 4 years. But looking forward, what will be the macroeconomic events like Russia having its foreign exchange reserves seized, like the banking crisis, and BTFP stepping in to save those banks, like the COVID stimulus, or like 2008 and Occupy Wall Street's inefficacy, and because of it not addressing the real problems. What are the events going forward? There's been some major event every year that has awakened people like Sam to like, what, it's time to take Bitcoin seriously. And so what will be the next series of events going into the years ahead, in addition to the halving that we have coming up in 3 months, and it all points back to, Glenn, what you were talking earlier about every cycle, there's some incremental slice of the adoption curve that comes into Bitcoin or progresses to the next stage of their Bitcoin adoption process. And the culmination of that is this 3 generations of behavioral shift away from how things are today to eventually just save your money in Bitcoin so you can work on your career and don't worry about investing because it takes care of you, because it's, finite absolute scarcity, and it tracks with overall GDP growth. Like that, and we're in the early stages of this process, and that's the end state. But, it's exciting that Sam had this series of events move him into a position of adopting Bitcoin for professionally. And who will be, coming down the pike because BlackRock, maybe that's the event right now that's happening, is suddenly Wall Street is switching from negative to positive on Bitcoin because of the marketing that comes with an ETF. And over the next year or two, there's going to be a lot more people pointing at that and saying, you know, that was actually the start of me learning about Bitcoin and coming around to it. So there's this lag effect between events and then people becoming Bitcoiners. Sam's a recent example, I guess, of the Russia event triggering, you know what, I'm going to go on a 2-year-long search for what's the right way to get my clients to take Bitcoin as an allocation. And you know, Glenn was the instrument of making this all happen. What happens going forward? What's the 2-year lag from the ETFs coming out now, the halving coming in April, and who knows what macroeconomic series of events into the future?
So you know what we've been hearing a lot about lately? It's kind of bizarre, right? So we had this government minister on Sky News, like with this very well-known TV presenter here in the UK, Kate Burley or something like that, asking him about comments that the general of the whole British Army had been making about potentially needing to get ready for a major world war, and that we may need to start conscription again, right? And I was watching this and I was thinking, what the hell are they talking about? Like, where's all of a sudden this coming from? You know, like, what are we getting ready for? Like, all of a sudden, like, this is the plan. Like, and he's saying, yes, we've got to get ready. Like, as if it's inevitable. You know, like, they come in, like, somebody's coming to get us. Yeah. And then, and I think what that's about, right, is always when the system's collapsing, right? Because you mentioned the unfunded liabilities, right? We got the same problem over here. It's just kind of different numbers, but relative to, you know, there it's like
300
100 trillion or 300 trillion. Here it's like only like 8 trillion, but relative to the side of the economy, right? And given that the total debt's only 2 trillion, right? It's like you realize that if I'm a political party or a politician, right, there's no way out here, because I can't tell people, oh, sorry, I know you put all that money into national insurance or social security, but I can't give you what I promised you. Well, then that's a next politician, you know. So you realize there's no kind of way out, and the game's kind of up, right? We're at that point now where the explicit liabilities are so high, and then there's all the unfunded liabilities and whatever. And so you need to use a World Economic Forum term, you need a great reset, right? And so, well, how did we have the last great reset, right? Because what happened is we kind of, the British pound was the global reserve currency in 1913, and they kind of did the stealth kind of QE to fund the First World War. Then, because they lied to the public, they had to go back on the gold standard at the same rate. They caused deflation, right? Then we had a worldwide Great Depression, right? And then we kind of did the New Deal and all of these kinds of things and whatever. But the game was kind of up, and then we had a world war, and then we had Bretton Woods, right? And then we ran that for 1970 till 1971, which was kind of a quasi gold standard, but really not a gold standard at all. Then we went from 1971 to today on this fiat standard, but even the game with that is now up, right? So now we've got to like create some huge calamity where it's sort of, we just erase all of that and then on the other side in the rubble will kind of like create some new standard, which will now be, some CBDC it'll be, because of cyber attacks, you have to have a digital identity, and this is what it's starting to sound like, because they're saying that Vladimir Putin is like now a risk to the whole of Europe, right? But he's still stuck in eastern Ukraine, just fighting the Ukrainians, right? So like, how is he all of a sudden a threat to Europe? So when they say things like this on national TV, and it's these very senior people and stuff, and they're absolutely illogical, they don't make sense, then I know there's a plan.
So we're going to rename Glenn Jones.
Glenn, I'm picking up what you're putting down.
Marty's there like, yeah.
War is the greatest jobs program humanity's ever known. It's.
I was going to go for something less extreme, but it sounds quite weak now.
No,
I think there's a shorter term. So I think the next wave will come from the institutions. I think that is where it will come from, and that's sort of what I envisaged a couple of years ago that we needed to get ready for. I think they'll be crying out for, not very much, but the small allocation we've talked about, and what will trigger that. I don't think it'll be the halving so much, although that might put it on the front pages a little bit more, which is helpful. I think it will be the next wave of inflation. So I mentioned earlier that one of the key risks that Bitcoin helps to protect against for institutions, it's counterparty risk and inflation risk. And we are, obviously, I've got no insider knowledge on this, but just sort of applying some Austrian school logic to it, we are coming to the point where the interest rate rises we've seen are going to lead to some kind of contraction, possibly serious contraction, the tide goes out, etc. And then the government and the central bank, and not just in the UK, but I guess in quite a few countries, is then going to be faced with the decision that it's been faced with quite a number of times before, which is, does it allow the economy to I was going to say collapse them, but sort of return to a more sustainable position, really, sort of unwind the excesses that shouldn't have happened in the first place, or does it print to push the future out a little bit further? And I think we'll probably see one and then the other, and so therefore we'll see a a reminder of the counterparty risk that corporate treasuries, pension schemes, etc., face, institutional investors generally, the counterparty risk that they face, and also the inflation risk that they face, and we'll see them in fairly short succession, because I think that's why a lot of pension schemes and their companies were more willing to take action in 2023 to lock in some of those higher interest rates that we saw on bonds, is because 2022, when bond yields were very low, was recent in their memory. So I think it needs that. It needs, for a general sort of awakening to a particular situation, it needs like two events within recent memory. And I think that's what there's a good chance that we'll get over the next, who knows, but 6, 12, 18 months maybe. And then hopefully that will mean that more people are thinking, okay, I think something doesn't feel right. It's going back, it's that feeling of uneasiness that, well, I don't know if it's the same for you, but I think it's probably the same. I'd suggest it's the same for everyone. To take action, to do something, you need to feel uneasy about your current situation. And it's that which then forces you, subconsciously or otherwise, to take action in a certain direction to try and ease that uneasiness, make yourself feel a bit better. And one way to do that is, of course, for these kind of things, to learn more about Bitcoin.
Yes. Do not be paralyzed by fear. Act. simple act can just be reading some information about Bitcoin to develop the confidence to then take another action, which is getting it on your personal or business balance sheet or pension balance sheet, whatever it may be.
Yeah, and if you want to learn more from Glenn's understanding of the system, you have to come to the UK and visit him and take him out to dinner, where I think we're getting kicked out of the studio, but looking forward to eating steak and hearing him expand on some of his Marty Jones thoughts.
Kindred
Yeah,
spirits,
let's go
Glenn.
with what Sam said. Ignore what I said.
I love Sam's pivot to the actionable.
Yeah.
Well, there's the short term and maybe the long term, which are not incompatible between what you guys were presenting. But yeah, I would love to hear more about that over a pint of bitter with Glenn and Sam. I'm jealous.
Yeah.
I think the key, if we're allowed to leave you with a sort of a key message from us, I think it's that this monetization phase that we've talked about, that is what creates the huge opportunity for institutions to dip their toe in the water. It's not going to be around forever. So act.
Yeah. Because Bitcoin is what it is, and you can't stop it. So it is inevitable. And if it's inevitable, it's going to monetize. So we don't know how long, over what period. It might be 5 years, it might be 15, it might be 50. Doesn't really matter.
No, and they're not making any more of it. There's only 21.
They're not.
So.
Well, they are still, but only very little bit.
Yeah, less and less. They're making less and less of it.
Who's making them, Glenn?
All right. Well, I'm extremely jealous. The FOMO is real right now across the pond. You gentlemen go enjoy your dinner and the conversation around that meal. And it was a pleasure meeting you, Sam, Glenn. Pleasure talking to you again. And for everybody out there listening, we'll see you next week.